Hey guys, welcome back. From time to time, I provide you guys educational videos to help you better understand how to analyze stocks and how Wall Street and professional analysts are analyzing the companies that you're investing in. And as a value investor myself, today's topic is near and dear to my heart. What is book value? And I want to start off by reading the quote we have here from Warren Buffett in the 1998 shareholders meeting, where he said, "Book value is not a factor we consider." Might be shocking if you're a value investor to hear Warren Buffett say that, and we might cover that in a future video. But with that in mind, to kind of set the stage, let's run through real quickly what is book value. In simple terms, book value, also known as shareholders' equity on our balance sheet, tells an investor how much a company is worth if it ceased operations and was liquidated. Book value is very easy to calculate. You just go to the balance sheet, take your total assets, and subtract the total liabilities, and that is your book value. On the balance sheet, you will see it notated as shareholders' equity. There is one other book value to know about that you might hear people talk about, and that is tangible book value, which is the same definition that we just used, but we're going to subtract out any intangibles on the balance sheet, like goodwill. Subtract out those intangibles and you get your tangible book value. You may often hear people talk about book value per share. Once you know your book value, you can divide that book value by the number of outstanding shares, and that will give you what we call book value per share. You can also calculate your tangible book value per share by dividing your tangible book value by the number of outstanding shares. The most common way that investors look at book value is when we are what I call dumpster diving. We are looking for companies where the market cap is below the book value. That might tell you that you have an undervalued company. Now, certainly there are a lot of other things you need to look at. You can't just say, oh, market cap is under book value, this is a good buy. No, instead what we do is we kind of set that up as a filter to give us a bunch of companies to look through where market cap is under book value. And then we need to do further analysis to find out why are they undervalued and are they a potential investment. Common ratios related to book value would be your price to book ratio. This measures a stock's price relative to the book value. And the easy way to calculate that is just to take your market cap and divide it by your book value. A price to book under 1 may indicate an undervalued company. If the price to book is over 1, then that tells you you have more work to do. There are many other indicators you should look into to see if the share price is justified. Expanding on that further, when our price to book is greater than 1, most investors, and especially professional investors, are going to look at other indicators for valuing a company or to see if a share price is properly valued. And one of the things that we're going to give a lot of weight to is expectations for future earnings. If you have a company that appears to be performing well with a price to book over 1, there are other indicators that I want you then to dig into. Price to earnings would be one of them, the PE ratio, ROE, return on equity, ROA, return on assets, ROIC, return on invested capital, the DCF model, discounted cash flow, EV to EBITDA, the enterprise value to EBITDA, EV to FCF, that's enterprise value to free cash flow, price to free cash flow, and finally price to operating cash flow. These are just the start of where to begin your evaluation. I want to caution you guys when you're trying to look at a share price out in the market and decide if it is overpriced, fairly priced, or underpriced. Do not make the error of just looking at book value and applying some multiple to it that you see other companies using and then making a choice that that price is properly valued, overvalued, or undervalued. Book value should not be the start of your share price valuation model. There are other things that you must look into to decide if a price is high, low, or just right out in the market. I hope this video helps you understand a little bit more about what is book value and how we use it. If you have comments or questions, let me know down below. I am Tony Denaro, and I will see you on the next video.